Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, June 30th, 2023. I know it sounds hard to believe, but this year is now halfway over. And given the stock market's anemic performance in December, I doubt many people expected the S&P 500 index to be up more than 15% since then. Even more surprising is the strong rally by tech stocks, which are up more than twice that amount as measured by the NASDAQ Composite Index. To be sure, Wall Street is playing it safe by concentrating its money in the biggest companies with the strongest balance sheets. On an equal weight basis, the S&P 500 is up less than 6% this year, while the small cap Russell 2000 index has done only slightly better, gaining nearly 8% during the first half of this year. Now, let me show you a few charts here. So here's the S&P 500 year to date. You can see way over here on the left, it got off to a good start in January. And then from first week of February all the way through mid-March, and again, the Silicon Valley Bank collapse happened right in here. Kind of almost got down to almost where it opened the year, but since then it's just been pretty much a steady climb. And if we broaden this out to 2 years, you'll see that it's still maybe a little less than 10% below its all-time high, but it's above this high here from last summer. So it's broken above that technical resistance, which is a good sign. And right now it just looks like to be a very healthy rally. If we look at the NASDAQ composite, which is mostly tech stocks, year to date, dropped some in March, but not as much, which is kind of interesting because Silicon Valley Bank basically catered to tech companies. But in any event, if we go out 2 years, you can see that it's also had a more severe drop because it became so highly valued during the pandemic. So, but on an equal weight basis, now let's go back here. First of all, here's the S&P 100, which is cap weighted, which means the biggest companies count for more and the smaller companies count for less in terms of the performance. Now, if we go over here to the equal weight S&P 500 and we do year to date, you can see that, yeah, it's up, but not nearly as much. So Wall Street definitely hiding out right now in large cap stocks. That discrepancy illustrates the degree to which Wall Street fears that an economic recession may still be in the cards. However, that concern should have been alleviated somewhat yesterday when the Bureau of Economic Analysis revised its estimate for gross domestic product growth during the first quarter this year, up from 1.3% to 2.0%. And here's the graph right here of the past 4 years. And granted, it's not much of a gain, but it's a gain. And it was more than they previously reported. So it's less than the 2.6% growth rate recorded at the end of last year, which is right there. But it's still high enough to suggest that the economy is holding up better than expected under the strain of high interest rates. Now, that performance has been enabled by falling fuel prices. The price of a barrel of West Texas Intermediate crude oil finished last year very close to $80. Yesterday it closed just under $70, which is about a third less than what it was at this time last year. And here's a chart of the past 2 years. And right here, I'm at, I go out, here's June of 2022. And you can see it early June of last year, got up to $120 a barrel. And now we're looking at $70 a barrel. So low energy prices help keep down the cost of production, which in turn reduces inflationary pressure on retail prices. Another key contributor to inflation is wages, which have been rising at a decelerating pace over the past year. Last summer, the annualized rate of wage growth peaked at 6.7%, which is what you see over here on the far right. This is the past, 15 years here on this chart. And you can see how much wages spiked over the past 2 years, really last 2 years. But they're still growing, but at a decelerating rate. In May, it fell to 6% for the first time since the Fed began raising interest rates in March 2022, despite the unemployment rate remaining below 4% during that entire time. The second half of this year may prove more difficult than the first half. Reducing the annual inflation rate from 8% to 4% is far easier than cutting it in half again. Thus far, OPEC's production cut announced in April has not driven up gasoline prices, but that could change during the summer driving season. However, change is not what Wall Street wants to see, given how good things have gone so far this year. I believe that is why the Fed decided to pause interest rate hikes this month to avoid disturbing equilibrium in the stock, bond, and commodity markets that I described 2 weeks ago, and I think they kind of just want to keep that the case over the summer. So that's today's PF update, and I look forward to talking to you next week, and have a safe and fun 4th of July week. Thank you, everyone.